Okay, imagine a totally new kind of money
Mm.
right there in your, well, digital pocket.
Mm-hmm.
It's issued directly by the European Central Bank, the ECB, and it's meant to uh, completely change how you pay for things.
This sounds revolutionary, doesn't it?
Sounds super efficient, right? Like a single seamless payment system for all of Europe. But what if that same digital money, comes with some hidden strings attached?
Oh, the catch.
Yeah, maybe controls we don't fully grasp yet, big privacy questions, maybe even a fundamental shift in your financial freedom.
It's a massive topic.
It really is. So today, yeah, we're doing a deep dive into the ECB's digital euro project. Some sources we looked at are saying it could actually get the green light as soon as this year.
While others are issuing some pretty stark warnings, I saw one headline saying this project should, quote, scare you, which is intense.
Definitely intense, and it's a really complex picture with lots of different viewpoints.
Absolutely. It's fascinating and, yeah, sometimes a bit alarming when you dig into the details. We'll be unpacking the latest reports, expert analyses, drawing insights from, well, a whole range of voices. We've got stuff from popular channels like Coin Bureau, more academic takes from people like Professor Dr. Christian Rieck, accessible explainers from EU Made Simple, and economic commentary from guys like Mark Vidal. Plus, the official documents and guides on CBDCs themselves.
A real mix.
A real mix. You get everything from cautious optimism focusing on efficiency, European sovereignty, all the way to quite grave warnings about potential surveillance and, well, a loss of individual control over your own money.
Right. And our mission for this deep dive, yours and mine, is really to cut through all that noise, try to demystify the digital euro for you, our listener.
Yeah, make it make sense.
Exactly. We want to explain the tricky concepts in simple terms, point out where the knowledge gaps still are things we don't quite know yet. We'll try to simplify the really complex bits, like this whole programmability debate.
Which is a big one.
Huge. And connect these ideas with some solid analogies so they stick. The goal is for you listening to walk away feeling genuinely well-informed, really equipped to understand what's actually at stake here.
Good plan. And maybe the best place to start to really get a handle on the digital euro is to think about money as we know it right now. There are basically two main types you interact with.
Okay.
First, there's the actual physical cash in your wallet, the banknotes, the coins. That's what we call public money. It's issued directly by the central bank.
Right, like the ECB for the euro.
Exactly. And its key features are, it's universally accepted, it works offline, crucial point, and it offers a really high degree of privacy. For small transactions, it's pretty much anonymous.
Okay, cash is public money. What's the second type?
The second type is the digital money you see in your regular bank account. Now, most people think of this as just digital cash, but it's actually private money.
Private. How so?
It's created by commercial banks, your high street bank, when they issue loans or accept deposits. It's essentially an IOU from your bank. So when you tap your debit card or use your banking app, you're spending this private digital money.
Oh, I never really thought of it that way. It's a liability of the bank, not directly central bank money.
Precisely. And this is where the digital euro aims to be something completely new, a third category. The idea is for it to be public money in digital form.
Okay, so like taking the characteristics of cash, the public central bank issued part, but making it digital.
That's the core concept. The goal is for it to work like digital cash, a universal payment option across Europe that works everywhere, just like physical cash, but importantly, both online and offline.
That offline part sounds significant.
It is, and it makes it very different from just using your current banking app, which relies on that private bank money infrastructure. And it's also completely different from cryptocurrencies like Bitcoin, which are decentralized and, let's face it, often very volatile. This is meant to be stable, sovereign, digital cash. #tag what exactly is the digital euro?
Okay, let's really nail down the basics then, make sure we're all starting from the same point. What exactly is a central bank digital currency, a CBDC? And then specifically, what defines the digital euro within that category? We hear the term CBDC thrown around a lot.
Right, it's become a bit of a buzzword. So at its heart, a CBDC is just what it sounds like. Public money in digital form, issued directly by a country's central bank.
Simple enough.
Yeah. And for Europe, the digital euro is planned as exactly that, a digital version of the euro cash we already use. It would be issued jointly by the European Central Bank, the ECB, and the national central banks within the Eurozone.
Okay. And who's it for? Is it just for banks to settle transactions between themselves? Or
No, and that's a really crucial point. It's
Yeah.
specifically designed for broad retail use. That means it's intended for everyday payments by absolutely everyone.
you and me?
You, me, small shops, big companies, everybody. It's not just for those big wholesale transactions between financial institutions, which is where central bank money mostly operates today. This brings central bank money directly into your, well, digital wallet.
So just to be crystal clear, it's not simply more numbers appearing in my existing commercial bank account, which is, let's be honest, how most of us already see digital money.
Exactly. It's a fundamentally different thing. We really need to distinguish it from the money we use now.
Okay, let's recap the types.
Right. You've got your physical cash, banknotes, coins. That's public money, central bank issued, works offline, high privacy, check.
Yeah.
Then your bank deposits, the balance in your current account. That's digital, yes, but it's private money created by commercial banks.
Right.
Your debit card spends this.
Right, the bank's IOU.
Exactly. And finally, you have crypto assets and stable coins, things like Bitcoin or Tether. These are private digital assets. Their stability varies wildly. Their governance is different. And they aren't generally considered legal tender.
Got it. So the digital euro fits in where?
It's designed to fill a very specific gap. To be public money, like cash, but also digital, universally accessible across the Eurozone, and directly issued and backed by the central bank itself.
So it's about keeping public money relevant in a digital age.
That's a big part of the narrative, yes. Ensuring there's still a sovereign public monetary anchor when everything else is going digital.
Makes sense. And just to hammer the point home, what is the digital euro definitely not? Is it just the EU's version of Bitcoin?
Absolutely not. That's a common confusion, but the sources are unanimous on this. It is not a cryptocurrency.
Why not?
Well, unlike Bitcoin, it's not decentralized. It's centrally issued by the ECB. And critically, its value will be stable, pegged one-to-one with the regular euro. There's no inherent price volatility or speculation like with crypto.
Okay, so not crypto. What else isn't it?
It's also not a bank deposit in the traditional sense. Holding digital euros would mean you have a direct claim on the central bank itself, not on your commercial bank. Theoretically, this makes it risk-free, unlike money in a commercial bank account, which carries, bank failure risk, however small.
Right. Deposit insurance exists for a reason.
Exactly. And one more thing the ECB keeps repeating, probably to calm public nerves, it's meant to complement, not replace, cash.
They say that a lot.
They do. It's positioned as an additional choice, another way to pay, designed to exist alongside physical cash and the private digital payments we already use. Whether it stays that way is, of course, a major point of debate we need to get into. #, why the rush? The drivers behind the digital euro.
Okay, so we have cash, bank deposits, crypto,
Yeah.
and now this digital euro aiming to be digital public money but not replacing cash. It does make you wonder, why the big push? Why are central banks, especially the ECB, driving this forward with such, apparent urgency right now?
That's the multi-billion euro question, isn't it? And a major driver, maybe the biggest one, according to several sources, is this concept of strategic autonomy.
Strategic autonomy. Sounds geopolitical.
It absolutely is. Right now, Europe is heavily reliant on non-EU networks for a huge chunk of its digital payments. We're talking mainly about the big US players, Visa, MasterCard.
Yeah, they're everywhere.
Everywhere. And one source pointed out something quite striking. The fees charged by these card companies apparently jumped by nearly 34% just between 2018 and 2022.
Wow.
Yeah. So there's a cost aspect, but more fundamentally, this reliance means that, and I quote one source here, a huge part of Europe's financial infrastructure sits under foreign control. That creates a vulnerability.
A vulnerability, how?
Exactly.
Right.
The concern is, what if a non-EU power, like the US, decided to exert pressure? They could potentially use sanctions or regulations targeting these payment networks to disrupt how Europeans pay each other, impacting the entire economy.
So it's about not being beholden to another country's payment rails.
Precisely. And ECB President Christine Lagarde was surprisingly frank about this in that infamous prank call that got leaked. She basically admitted, we don't want to be dependent on an unfriendly country's currency. And interestingly, she added, or a friendly currency that comes from a private entity.
Like Facebook's Libra project, Or maybe US dollar stablecoins.
Exactly what she seemed to be referencing. So the digital euro is very clearly seen as a way to build a sovereign rail with European governance. It's about reducing that external dependency, strengthening Europe's economic independence in the digital sphere.
It's really about digital sovereignty then, not just payment efficiency, a kind of economic defense mechanism in the digital age.
That's a great way to put it. It's about Europe trying to carve out its own space, its own control, in a world increasingly dominated by non-European tech and finance giants. It hints at a new form of maybe digital economic nationalism.
Fascinating. Okay, beyond sovereignty, the sources also talk a lot about resilience and financial inclusion. How does the digital euro supposedly help there?
It's pitched as a kind of public fallback option. The idea is it could keep working even if commercial systems fail, maybe due to cyber attacks, technical outages, or even cross-border payment friction.
And the offline feature plays into that.
Big time. That planned offline capability is specifically highlighted for resilience. If the internet goes down or there's a power outage, the theory is you could still make small, essential payments, device to device.
Like a digital safety net?
Sort of, yeah. And on the inclusion side, the goal is to ensure basic digital euro payment services are free for everyone. This is aimed at supporting financial inclusion, making sure people who have limited or no access to traditional banks aren't left behind as society becomes more digital.
That sounds like a public utility argument, making sure everyone has access to a basic, essential service.
That's exactly the analogy proponents use. Think about water or electricity. If you only rely on private companies and they fail or charge too much or cut people off, you've got a problem. A public option provides a baseline guarantee of access, reliability, and resilience for everyone. The digital euro is framed in that same way, a stable, accessible public payment method.
Okay, makes sense. What about the economic arguments? Things like boosting competition, maybe lowering fees for shops.
Yeah, that's another key selling point. Proponents argue that introducing this neutral public payment layer could shake up the market and increase competition.
Oh,
By putting pressure on the fees merchants currently pay to the big card networks, which can be pretty high, some sources describe the current situation as a duopoly that might even be holding back innovation by European fintech companies.
so the digital euro could give them a cheaper, unified alternative to build on.
That's the hope. A cheaper rail for merchants across the Eurozone, potentially stimulating new payment features and services developed by European companies.
So, summing up the why.
Mm.
It's about sovereignty, resilience, inclusion, competition, lower fees, and basically future-proofing public money itself.
Exactly. The ECB frames it as ensuring public money stays relevant and usable in a world that's increasingly digital and potentially involves programmable services, whatever that means, and we definitely need to unpack that term later.
We do. But this whole push for autonomy, it does raise a question, doesn't it? Given how global tech is the hardware, the software, the networks, how can any digital currency truly be independent of foreign tech influence? That seems like a huge challenge.
That is a critical knowledge gap right there. How do you build a sovereign digital system on top of fundamentally globalized technology infrastructure? It's a paradox they'll have to address.
Right, so we've covered the what digital public money and the why sovereignty, resilience, future-proofing. Now let's really get into the nuts and bolts. How would this digital euro actually work for you, the user? If the ECB issues it, does that mean I dish my bank and get an account directly with the central bank? That sounds radical.
Yeah, that's a really common question, and probably a source of anxiety for commercial banks too. But no, that's not the plan. The model the ECB is going for is called intermediated.
Intermediated, meaning?
Meaning the ECB issues the money itself, sets the rules of the game, the overall framework, but the part you interact with, the customer-facing services, that gets handled by private companies.
Like my existing bank.
Exactly. Your existing bank or other regulated payment service providers, PSPs, those fintech payment companies, you'd likely open your digital euro wallet through them. It might even just be a new section within your current banking app.
Ah, okay, so the banks still manage the customer relationship.
Precisely. It keeps them central, but introduces this new public currency rail operating underneath. Now, some sources did mention the ECB might offer its own very basic app as a sort of fallback, but the main strategy relies on the existing financial players for distribution and service.
So getting set up would feel pretty familiar then, like opening any other account.
Pretty much, yeah. The onboarding process would likely mirror opening a standard bank account. You'd need to go through the usual know your customer, KYC identity checks. Anti-money laundering rules still apply.
Standard stuff.
Standard stuff. Initially, the focus will be on people and businesses within the EU. Maybe later they'll explore use in selected third countries, but that's further down the line.
Okay. And you mentioned something about only having one account.
Yes, this is quite important. To manage the system, and especially the holding limits we need to discuss, you'd likely be allowed only one digital euro account that will be shared across all your bank accounts.
How will they enforce that?
Through a unique digital euro account identifier. Think of it like a specific ID number for your digital euro holdings, potentially linked to the upcoming EU digital ID system. That way, they can track your total holdings across different providers.
Right. Prevents people from opening multiple wallets to get around limits. Okay, so I'm onboarded. How do I actually use it? Online first.
Online payments should feel very much like the instant payments we have today. Fast, integrated into your wallet or banking app, transactions clearing pretty much in real time. The goal is seamless convenience.
Okay. Standard online. But the offline part sounds more novel. How's that supposed to work?
Yeah, the offline capability is a key selling point. It's designed for device-to-device payments. Think phone-to-phone, or maybe a dedicated physical card tapping against a phone or terminal.
And the privacy aspect.
They aim for cash-like privacy at the moment of transaction. Meaning, in theory, only the payer and the payee know the details right then and there, without an immediate central record. It's designed to work temporarily without connectivity for smaller amounts.
Temporarily. So it's not truly anonymous like cash.
That's the catch. The transactions are recorded locally on the devices involved. As soon as those devices reconnect to the network, the transactions are reconciled and become part of the overall ledger. So offline privacy is temporary.
I see. And would this require special hardware?
Sources suggest specialized hardware could be mandated for all physical devices involved in offline payments. Think secure chips, like the secure elements already in smartphones and credit cards, to manage the offline balances and ensure security. And for people without smartphones, they're considering a physical digital euro card, too.
Got it. Now let's talk about those holding limits. You mentioned them earlier. This seems like a really big deal, limiting how much digital euro I can actually keep. Why?
It is a really big deal and probably one of the most debated features. Yes, individual accounts will have holding limits. Fabio Panetta, an ECB board member, publicly mentioned a figure of around 3,000 euros.
That's not a huge amount.
No, it's not meant to be a primary store of wealth, though Panetta did add that this limit will likely be increased over time. Interestingly, accounts for businesses, institutional accounts, are not expected to have these limits.
Okay, but why limit individuals at all?
The core reason is to prevent bank disintermediation. That's the technical term. Meaning they're worried that if people could hold unlimited amounts of risk-free digital euros directly with the central bank, they might pull huge sums of money out of their commercial bank accounts, especially during a financial crisis.
Yeah, the digital bank run scenario again. People fleeing to the perceived safety of central bank money.
Exactly. If everyone suddenly moved their savings from commercial banks to digital euros, it could drain the banks of deposits and potentially destabilize the whole financial system. They saw warning signs of this with the U.S. bank runs in early 2023. This is a direct response.
So the limit is there purely to protect the commercial banks?
Primarily, yes. To manage this risk and maintain the stability of the existing two-tiered banking system.
And how do they enforce it technically?
Yeah.
If I receive a payment, that puts me over the limit.
Through something called the waterfall functionality. It's quite clever, actually.
Okay.
Any digital euros you receive that push your balance above your personal holding limit, let's use that 3,000 figure, are automatically, instantly converted into regular euros and deposited into your linked commercial bank account.
So it just overflows into my normal account.
Exactly. It waterfalls over.
Okay.
The system prevents your digital euro balance from exceeding the cap.
Can you give us an analogy for that? It helps to picture it.
Sure. Imagine your digital euro wallet is like a personal piggy bank, but it has a strict fixed size, say. It can only hold 3,000 euros worth of special digital coins.
Okay.
Now, if someone tries to put more coins into your piggy bank once it's full, those extra coins don't just bounce off. Instead, there's a little chute, the waterfall, that automatically guides those excess coins directly into your regular big bank account jar next to it.
Ah, I see. The piggy bank stays capped, and the rest flows safely into the main bank account.
Precisely. It ensures the piggy bank, digital euro wallet, never gets too full, which protects the stability of the main banking system, commercial banks, by preventing a sudden drain of funds.
Clever. Okay, last piece on how it works. Fees. Will it cost me anything to use this? And what about shops?
For consumers, the plan is that basic services will be free. opening a wallet, holding digital euros, within the limit, of course, making basic payments that should cost you nothing.
And for merchants, the shots in businesses?
The digital euro scheme actually proposes making it mandatory for all businesses in the Eurozone to accept it as a payment option, just like cash or cards.
Mandatory acceptance, wow.
Yeah. And the fees they'll be charged are targeted to be low, around the level of current debit card or instant payment fees, so potentially much lower than credit card fees. There are supposed to be caps to prevent excessive charges, avoid squeezing businesses.
Wow. Can they really mandate acceptance even with cash? Sometimes shops refuse it.
Right, that's a valid point some sources raise. Even if it's legal tender, existing laws in some places do allow merchants to refuse specific payment methods under certain circumstances. So just mandating it might not guarantee 100% acceptance everywhere. The real-world convenience and cost factors will likely play a big role in how quickly and widely merchants truly embrace it.
Okay, this next section is where things get, well, really interesting, maybe even a bit spooky for some people. This whole idea of programmability. We heard early on that the digital euro might be programmable money, which immediately conjures up images of money that expires, or money you can only spend on certain things. Basically, someone else controlling your funds.
Right, that sent up a lot of red flags.
Exactly. But then the ECB seemed to do a sharp U-turn, insisting very publicly that the digital euro will never be programmable. So what is going on here? It feels like a lot of careful wordplay.
You've hit the nail on the head. This is precisely where we encounter what some critics call intense semantic gymnastics. The ECB is trying very hard to draw a distinction between two concepts: programmable money and conditional payments.
Okay, break that down for us. What's the difference, cutting to them?
According to the ECB, programmable money, which they claim they reject for the retail digital euro, would mean the currency itself has rules embedded within it. Rules that dictate or restrict where or when you can spend it.
Like the examples you mentioned, money only for groceries, or money that disappears if you don't use it fast enough.
Exactly. Or money that only works in a certain area. That's where you hear those controversial links to things like 15-minute cities, though the ECB denies any such intent. That kind of built-in, centrally dictated restriction is what they say programmable money is, and they claim they won't do it.
Okay, so that's what they say they won't do. What about conditional payments, which they do seem to support? How is that different?
So conditional payments are framed as optional services. These wouldn't be built into the money itself, but offered by the intermediaries, your bank or payment provider. Examples they give are things you might set up yourself, like automating a recurring payment.
Like my rent going out on the first of the month.
Exactly. Or triggering a payment only when a specific pre-agreed condition is met. Maybe an insurance payout that happens automatically when a certain event is confirmed by a sensor, for instance. The ECB insists these are fundamentally different because, they argue, the user would always choose to use these services and set the conditions themselves. It's user-controlled automation, not centrally imposed restriction.
Okay. Optional user-defined conditions versus built-in currency rules. That's the line they're drawing.
That's the line.
But do the sources buy that distinction? Does it hold up under scrutiny?
This is where the skepticism comes in, and strongly. Sources like Coin Bureau and especially Prefer Rake argue quite forcefully that this distinction is, well, largely semantic. They contend that many of these proposed optional conditional payments are, in functional terms, a form of programmability.
How so? If the user agrees to the conditions.
The argument is that the underlying capability for this system to enforce conditions is what matters. Who ultimately controls the infrastructure that makes these conditional payments possible? And could those capabilities be repurposed later? Remember Lagarde's comments in that prank call.
Right, that digital euro transactions would be controlled by the ECB.
Yeah.
And her worry about having no controls on small payments.
Exactly. Those comments strongly suggest that central control and programmable features are, at the very least, being considered or built into the architecture, regardless of the current public stance on retail programmability. Plus, the official documents mention that the supervised intermediaries, banks, PSPs, are best placed to develop these conditional services, but also that the ECB itself might assist or even provide its own conditional payment services on the back end, especially for institutions.
So even if it's not directly controlling my spending today, the central bank could be building the tools and influencing the intermediaries who could implement restrictions later. Raises questions about scope creep.
Precisely. It raises huge questions about the potential for future controls, even if they start small and optional. Is the underlying infrastructure being built in a way that enables programmability, even if the switch isn't flipped on day one?
This idea of controlling money, making it expire, or restricting its use, is this completely new? Or have we seen similar things before in history?
Oh, absolutely not new. History is full of examples of authorities trying to influence how money is used or valued. It's a recurring theme.
Give some examples.
Well, Professor Rieck draws a powerful parallel with Fürstengeld, prince's money, back in medieval times. Rulers could literally decide to depreciate the coins in circulation overnight, stamp them with a lower value, or even declare certain coins completely worthless.
Wow. Imagine waking up to find your savings slashed by decree.
Exactly. It's a historical example of remote control over people's money, a direct parallel, Rieck argues, to how programmable digital money could allow a central authority to alter your fund's value or usability without your consent.
Chilling. Any other examples?
There's the concept of demurrage, basically, money that loses value over time if you just hold on to it. The most famous modern-ish example is from Virgil, Austria, in the 1930s. They introduced a local currency with a 1% monthly depreciation rate.
To force people to spend it.
Precisely,
Yep.
to keep the money circulating during the Great Depression. And it worked spectacularly well. Locally, unemployment plummeted, trade boomed, but the Austrian central bank quickly banned it because it challenged their control over national currency. More recently, things like the Bristol pound in the UK used annual fees to encourage spending. These are real-world examples of money with built-in expiry or decay.
Of making money hot so people don't hoard it.
Exactly. And even more recently, we've seen negative interest rates. Sweden did this from 2015 to 2019, charging banks to hold reserves, which indirectly pushed down rates on savings. The explicit goal was to incentivize spending and discourage excessive saving. As Mark Vidal and Coin Bureau noted, it effectively nudged people to move money into other things, like investments or bonds, just to maintain its value.
So, history shows authorities have long tried to steer economic behavior using monetary tools. But digital tech could make these controls infinitely more precise and pervasive, couldn't it?
That's the fear. What used to require physically restamping coins or complex banking policies could potentially be done with a few lines of code in a centralized digital currency system.
Okay, let's try another analogy to really cement this programmability idea. How does it compare to regular cash?
Right. Think of your regular cash, the euros in your pocket now, as being like a universal gift card. No restrictions, you can use it anywhere, anytime, for absolutely anything, and it never expires. It's totally flexible.
Okay, universal gift card.
Now, programmable money, or even money subject to certain conditional payments, is more like a highly specific smart voucher. This voucher might only work at Tesco, and only for buying fruits and vegetables. And maybe it expires next Tuesday if you haven't used it.
Ah, okay. The restrictions are built into the voucher itself.
Exactly. The fundamental difference is whether the currency itself dictates its use, its validity, its lifespan, rather than just your personal choice or the agreement between you and the merchant. That shift from a universal tool to a potentially restricted voucher is what lies at the heart of the control versus convenience debate.
Okay, we've talked a lot about the potential benefits, efficiency, sovereignty, inclusion. But despite all the official assurances, privacy remains this huge, looming concern for so many people when they hear about the digital euro. What are the specific worries our sources are flagging up here?
Yeah, privacy is arguably the biggest hurdle in terms of public acceptance. The number one concern, echoed across pretty much all critical sources, is the fundamental non-anonymity of most digital euro transactions. The official line often includes phrases like, "It is traceable who paid whom, what."
Traceable? That doesn't sound very private.
It doesn't. Now, they often qualify this by saying the central bank itself won't have access to granular individual transaction data, but the capability for traceability seems inherent in the design for online transactions, and even the much-vaunted offline payments, while offering cash-like privacy at the moment of exchange.
There's a but coming, isn't there?
There is. Those transactions become visible and get reconciled centrally the moment you're back online. So that true, permanent anonymity that physical cash offers, it seems largely absent from the digital euro system as currently conceived.
And haven't the messages from the ECB itself been a bit confusing on privacy?
That hasn't helped build trust, no. You had Fabio Panetta initially saying the ECB lacks the capacity to see individual transactions, but then later admitting the ECB does have an interest in tracking aggregated data for policy purposes. It creates uncertainty.
Yeah, that sounds contradictory.
It does. And add to that the vision of QR code payments, which often involve linking to digital ID wallets, potentially giving apps camera access. It fuels fears of unprecedented surveillance.
And the comparisons to China's system.
They come up constantly. China's digital yuan is openly designed to be fully traceable and is used by the state to track transactions and control financial behavior. The worry expressed by channels like Coin Bureau and academics like Professor Reek is that Europe, even if it starts with different intentions, could slide down a similar path towards pervasive financial monitoring. Every transaction leaving a permanent digital trace.
A worrying prospect.
Okay.
Moving from privacy to stability. We talked about holding limits and the waterfall function preventing bank runs. How significant is this risk of bank disintermediation, really?
It's treated as a very significant risk by the ECB and economists. Those mechanisms, the limits, the waterfall, are direct, explicit measures to counter it. If the digital euro were truly unlimited and perceived as perfectly safe central bank money,
People would flock to it in a crisis.
exactly. They might move vast sums out of commercial banks, especially weaker ones, triggering those digital-era bank runs. This could starve banks of deposits, disrupt lending, and severely destabilize the financial system. So even though the ECB needs the banks for onboarding and services, the design carefully balances things to prevent the digital euro from draining deposits from the commercial banking sector. It's a necessary compromise to keep the current system stable.
Okay, what about the risk of leaving people behind? Digital exclusion. Not everyone has a smartphone or great internet, right?
Absolutely. That's a major risk, especially in a diverse continent like Europe. You have elderly populations, people in remote areas, those with disabilities, or simply those who aren't comfortable with digital tech. A purely digital currency could easily exclude them.
So what are the proposed solutions?
They're talking about mitigations like card-based options or simple secure element devices, maybe a basic fob or card that can hold and transact digital euros offline, plus ensuring there are human-assisted onboarding processes and making that offline functionality really robust are key to making sure no one is left behind. It's crucial for fairness and universal access.
Right. Now, maybe the deepest fear tying some of this together is scope creep. The idea that even if it starts out relatively benign, the system could gradually evolve to exert more control.
Yeah.
That the initial promises might not hold.
This is perhaps the most fundamental anxiety, the one that goes beyond specific features to the very potential of the system. Even with clear promises today about no programmability for individuals, the scope creep fears are pervasive.
What kind of future controls are people worried about?
The worries range widely. Could it eventually be used to restrict spending on certain goods or services deemed undesirable? Could savings limits be tightened drastically? Could it be used to nudge or even force spending towards government priorities like funding climate initiatives or military spending by, say, making savings depreciate unless invested in specific bonds? Could it be linked to travel restrictions or social credit style systems down the line?
These sound like dystopian scenarios.
They do, but they stem from the potential power a centralized, traceable digital currency gives to the issuer. Professor Reek makes a powerful point about cash's historical role. He argues the anonymity of cash was vital for citizens' freedom from constant state oversight.
Allowing people to transact without asking permission.
Exactly. As he put it, cash gave us, as normal people, the freedom not to ask some authority for permission every time we do something. If the digital euro becomes dominant, potentially displacing cash, and it remains fundamentally not anonymous, Reek argues it represents a profound erosion of individual freedom. Mark Vidal echoes this, warning it could turn citizens into simple pawns of a centralized chess game, their financial lives dictated by algorithms and top-down policies, leading to a loss of autonomy.
This brings us to another crucial knowledge gap, doesn't it? If they promise cash-like privacy offline, what are the actual verifiable guarantees? What stops that data being accessed or aggregated once it hits the central system?
Precisely. That's knowledge gap number 2 we need to flag. What are the specific technical and legal mechanisms that will absolutely guarantee that reconciled offline transaction data cannot be accessed or used for surveillance by the central bank or any other government body? Assurances aren't enough. We need to see the auditable code, the independent oversight, the robust legal firewalls. Without those concrete, verifiable guarantees, the privacy concerns will rightly persist. Hashtag the digital euro's evolution and future.
Okay, so we've dug deep into the design, the drivers, the potential benefits, and the very real risks. The massive question hanging over all of this is when? When might we actually see this digital euro land in our digital wallets? What's a real timeline?
Right, the timeline question. Well, the project officially kicked off its investigation phase back in October 2021. Right now, we're in what they call the preparation phase, and that's scheduled to run until October 2025.
October 2025. So is that the launch date?
Yeah. No, and this is really important to clarify. October 2025 is not the launch date. It's the end of the current preparation phase, where they're finalizing the rulebook and selecting providers. An earlier roadmap did mention a legislative proposal potentially around Q2 2023, maybe October 23rd of some year, according to Lagarde, but that's just the start of the political process.
So legislation needs to pass first.
Absolutely. Actual issuance of the digital euro requires final EU legislation to be debated and approved by all the member states. That takes time. Then the ECB Governing Council has to make a separate formal decision to actually go ahead and build and launch it.
So if all that happens, what's a realistic time frame for consumers?
If it gets the green light politically and technically, the actual rollout would likely be phased and could still take another 2 or 3 years after the preparation phase ends. So most realistic estimates point towards a possible 2028-2029 consumer availability window.
2028 or 2029, that's still a ways off.
It is, although some more, let's say, bearish or accelerated sources suggest it could come as soon as 2025, but they usually add crucial caveats.
Like what?
Like needing certain prerequisites in place. First, widespread adoption of a European digital ID seems key, and potentially needing some kind of crisis to force its adoption. That crisis narrative keeps popping up.
Interesting. And how has the public been involved in shaping this? We hear about stakeholder consultations.
Yeah, the ECB talks about consulting stakeholders. That term often includes governments, big corporations, financial institutions, sometimes linked to groups like the World Economic Forum. They also say they consult society at large, and sources do admit there's been a recent change in tone from the ECB, perhaps reflecting some public pushback, especially on privacy.
But who gets the final say on the design?
That's the crucial point. The really detailed finalized design discussions seem to be happening primarily with those key stakeholders, not necessarily through broad public forums. And it's interesting because the ECB's own surveys show a potential disconnect. Their surveys found that an overwhelming majority of Europeans believe that having access to cash is important. Digital payments apparently are not nearly as popular as advertised by some proponents. People in countries like Austria, Germany, Cyprus were particularly strong on wanting to keep cash access. So there might be a gap between the institutional push and what a lot of the public actually wants.
That resistance, combined with the crisis narrative, it does make you wonder if a major shock could be used to push adoption, doesn't it? Make it seem unavoidable.
Sources explicitly float this possibility. One noted that for the initial distribution, the easiest way would be to find an excuse to issue more stimulus payments, pointing out that the pandemic stimulus globally really accelerated interest in CBDCs.
So a crisis creates the need or the opportunity.
Or the justification. The argument could be made that in an era of global instability, commercial confrontation, the digital euro becomes a necessary and unavoidable tool for European sovereignty. It ties back into that strategic autonomy argument, potentially leveraging fear or necessity to overcome public reluctance.
Can we use an analogy for that? How a crisis might drive adoption?
Sure. Imagine a city builds a brand new, state-of-the-art public water system as a backup. But most people are happy with their existing private water companies, so adoption of the new public system is slow.
Okay.
Then, a major drought hits, or the private companies suffer a massive contamination issue or infrastructure collapse. Suddenly, that public water system isn't just a nice-to-have backup, it becomes absolutely essential for survival. People switch over rapidly, maybe even mandated by emergency measures.
So a failure in the old system makes the new one indispensable.
Exactly. That's the kind of scenario some sources suggest could dramatically accelerate digital euro adoption, shifting it from an option to a perceived necessity, possibly even bypassing some of the public debate.
Given all these complexities, the potential resistance, are there alternatives the ECB might pivot to if the digital euro project stalls? A, plan B?
Yes, alternatives are definitely being discussed. One that gets mentioned frequently is euro stablecoins.
Stablecoins?
Yeah.
Like Tether or USDC, but backed by euros.
Essentially, yes, but likely more tightly regulated and possibly backed directly by high-quality assets like EU government debt held by private issuers or potentially even reserves at the central bank. They're seen as a viable alternative.
Why would they be an alternative? Don't they have some of the same issues?
They might be politically easier to implement than a full CBDC. They could still allow the ECB a degree of oversight and control over transactions, perhaps indirectly through regulation. One source even suggested stablecoins could help subsidize heavily indebted Southern European countries if they were backed by their government bonds. There's speculation the ECB might ditch its digital euro desires and stick to euro stablecoins if the political headwinds get too strong.
Interesting. Are there other models besides full CBDC or private stablecoins?
Yes, there's talk of hybrid CBDCs. This is kind of a middle ground. Imagine stablecoins issued by private companies but fully backed by reserves held directly at the central bank or by commercial bank deposits under strict oversight.
So private front end, public back end.
Sort of. These could potentially arrive much sooner than a full retail CBDC and might still incorporate features like limits or programmability, but with different entities pulling the strings, maybe a consortium of banks working with the ECB.
So the control could still be there, just exercised differently?
Potentially, yes. And one source raised a really provocative point. They suggested a global system dominated by just one or two massive private stablecoin issuers could actually be more dystopian than having multiple national CBDCs.
More dystopian.
And their argument was that a single private entity controlling a global payment network might have even less accountability and more concentrated power than national central banks, which are at least subject to some form of public or governmental oversight. It's a fascinating counterargument to the anti-CBDC stance.
Wow. Lots of potential futures for digital money. This leads us to our final knowledge gap question for you, the listener. Beyond just promises, what would really convince you?
Yeah, knowledge gap number 3. What are the precise conditions or indicators, verifiable design elements, specific legislative clauses, independent oversight bodies that would definitively signal that the digital euro is not intended to replace cash or enable pervasive surveillance? What concrete proof points would move the needle beyond mere assurances and truly address these fundamental concerns about freedom and privacy? That's what needs absolute clarity. #tag outro.
Well, we have certainly covered a lot of ground today. We navigated the, let's be honest, incredibly complex and often quite contentious landscape of the digital euro.
We really did.
From defining it as this new form of public digital money to understanding the big drivers behind it that push for sovereignty, for resilience. We dug into the practicalities, the intermediated model with banks still involved, those crucial holding limits, and the waterfall idea.
And tackled that very slippery concept of programmability versus conditional payments.
Definitely slippery. And importantly, we shone a light on the significant risks that keep coming up. The worries about privacy, the concerns for financial stability, and that deep-seated fear about losing individual freedom, drawing parallels to how authorities have tried to control money throughout history.
And throughout this deep dive, we've really tried to use that Feynman approach, breaking things down, using simple terms and analogies, aiming to demystify concepts that are often wrapped in technical jargon or political spin.
Yeah, hopefully cutting through some of the noise.
And we flagged those critical knowledge gaps, the areas where we still need much clearer answers and verifiable guarantees, particularly around true independence, privacy safeguards, and the long-term intentions regarding cash and control. Those are the questions you need to keep asking.
Absolutely. Because the digital euro, it's clearly so much more than just a new app or a faster way to pay. It feels like it represents a potential, really fundamental shift in the nature of money itself, and definitely in your relationship with your money.
It forces some profound questions, doesn't it?
It really does.
Yeah.
Like, in this increasingly digital world, what does financial freedom actually mean anymore? And how do we make absolutely sure that the undeniable convenience of digital doesn't accidentally pave the way for unprecedented levels of control over our economic lives?
Is money that can be programmed that could expire or be restricted remotely? Is that still truly money in the way we understand it? Or does it become something else? Like that smart voucher analogy, or as one expert starkly put it, potentially Furstengeld on steroids.
A powerful thought to end on. And as this digital euro project continues to move forward, and it does seem to be moving forward steadily, it's just so vital for all of us to stay plugged in, stay informed.
Pay close attention to the legislative details as they emerge. Scrutinize the clauses on privacy, on the holding limits, on the precise definitions around programmability and conditionality.
Keep asking the tough questions. How will this impact my daily life, my choices, my autonomy, and demand clarity, demand those verifiable safeguards we talked about, because ultimately, the future of your money is being debated right now.